Welcome everyone to today's webinar. We're really thrilled to have such a huge turnout of colleagues from all over the globe. As I said, this webinar is hosted jointly by IISD and the International Senior Lawyers Project. My name is Alexandra Reedhead and I'm the Director of our Tax and Sovereign Debt Program at IISD. And it's a pleasure to have you with us today. This work that we do together with the ISLP is to support countries to understand and adapt to the global minimum tax. We have published a guide last year which aims to try and simplify and distill the rules relating to the global minimum tax. And since then, we've been supporting several developing countries to better understand the global minimum tax and what it means for the future of investment incentives in their country. And as ISD, we've been working with many countries more broadly to review the design and use of their tax incentives in light of the global minimum tax, but also taking into account other investment considerations as well, together with ISD's investment law and policy program. The purpose of the webinar today is really to do two things. The first is to provide some updates on the global minimum tax rules, or the GLOBE rules, and our colleagues, Zach Buga, a partner at Ernst & Young, and Stephen Shea, Senior Tax Fellow at Boston College, and both ISLP volunteers will take us through that. And then secondly, to better understand the implementation experience. So many developing countries are already well underway when it comes to implementing a response to the global minimum tax. And the purpose of this webinar is to give them an opportunity to share their experiences and the insights that they have gained. So that's the objective of the webinar. If I can turn to the next slide to briefly set out the agenda, I will provide a very quick refresher on the global minimum tax. We appreciate that the participants today come from a range of different backgrounds. Some of you live and breathe the global minimum tax and are tax professionals, but many of you also come from investment policy backgrounds and other disciplines as well. So this is really just a quick overview to get everyone on the same page. Then we will proceed to the technical updates to the Pillar 2 rules led by Zach and Steve, and then to the implementation experience in developing countries. And we've got several colleagues with us today from Papua New Guinea, from Colombia, from Zimbabwe, and also from academia. And then finally, my colleague Kudzai Mataba from ISD will launch a brand new policy brief that we have at ISD today on the impact of the global minimum tax on special economic zones. So that's how we plan to organise ourselves. There will be two opportunities for questions and for comments immediately after the technical updates, and then again after we hear from the panelists discussing the implementation experience in developing countries. I encourage you to take advantage of the Q&A function where you can register your questions, and also feel free to use the chat function as well. We do have interpretation, so we'll do our best to translate your questions that we might receive in French and Spanish as well. So please make use of the opportunity to ask the questions that you have to our panelists and speakers today. If I can move to the next slide. Thanks, David. So this is very quickly a refresher on Pillar 2, or the global minimum tax rules. So the global minimum tax rules is a huge step forward in terms of dealing with tax competition. It represents significant momentum amongst countries to combat harmful tax competition. And we understand that while it's a political compromise and it's not perfect, and it doesn't reflect some of the interests and concerns of developing countries, we think that it is still a positive step forward, and it does provide important political momentum and political cover for developing countries looking to rethink the design and use of tax incentives in light of GLOBE, but also more broadly other investment considerations. So what is the global minimum tax? If we can turn to the next slide. So the global minimum tax is part of a package of rules designed by the OECD G20 Inclusive Framework. And they're rules that are aiming to address some of the challenges arising from the digitalization of the economy. The first rule, or Pillar 1, is trying to tackle the situation where companies might sell goods or services into a country where they do not have a physical presence, and therefore they do not have a tax liability. So it does this by creating a new taxing right in the country where those goods and services are sold. Pillar 2, which is the focus of our webinar today, the global anti-base erosion rules, aims to deal with tax competition. So what it does is it says that in-scope multinationals, so companies with an annual turnover of more than 750 million euros, must pay an effective tax rate of at least 15% in each country where they operate. And this is designed to try and deal with the problem of tax competition, the race to the bottom, and the loss of revenue that results from that. So these are part of a package of reforms, but they are also distinct, and I'll come back to that later on. So if I can go to the next slide, how does the global minimum tax work? So as I mentioned, the intention is that companies that are in scope, that have a turnover of more than 750 million euros per year, must pay at least 15% in each country where they operate. How is that effective tax rate calculated? It's calculated each year in each jurisdiction where the M&E operates and conducts business. It does that by taking the covered taxes, so that is corporate income tax, dividend withholding tax, and other profit-based taxes. It takes that amount and it divides it by the globe income. And the globe income is the profit or loss before income tax minus any deductions for substance-based income. So that is, for example, payroll expenses or tangible investment. So if that amount equals less than 15%, so if the effective tax rate is less than 15%, then it triggers a top-up tax in that jurisdiction, right? So that's how the global minimum tax is calculated. We take the covered taxes, which are essentially all the taxes that are profit-based, divided by the profit before income minus deductions for substance-based income. And then if the result is less than 15%, a top-up tax is triggered. Turning to the next slide, how is the top-up tax collected? So there are 3 ways that the top-up tax can be collected in the following order. The first is through a qualified domestic minimum top-up tax. So what this is that if the country where the undertaxed income arises gets the right to collect the top-up tax, right? So the country where that undertaxed income occurs can collect the top-up tax through a qualified domestic minimum top-up tax. If that country, the source country, chooses not to collect the top-up tax, then by default, it goes to the country where the ultimate parent entity of the multinational is located. And this country collects the tax through the income inclusion rule. If both the source country and the country where the ultimate parent entity is located choose not to collect the top-up tax, then it can go to a third country with a constituent entity in the same group, and that third country collects the tax through an undertaxed profits rule. So you can see there are several interlocking rules here that make up the globe rules. If I can turn to the next slide, thanks. The last point that I wanted to make here is really just to set the record straight. So I think that the media around these global tax reforms can be quite confusing for countries and other stakeholders. I mentioned at the start that the global minimum tax is part of a package of global tax reforms from the inclusive framework. And while the first pillar is stuck, so there has been a lot of debate on whether or not the first pillar will go forward, and if so, in what form, the second pillar is very much going ahead. And many, many countries have now already made public commitments or are already in the process of implementing their response to the global minimum tax. And it's very important that developing countries are not left behind, because ultimately, if developing countries or the country where the undertaxed income arises choose not to collect the top-up tax, then another country will. So that is, in a nutshell, the global minimum tax. Just to get everyone up to speed, apologies for those of you who are very familiar with these rules. It's very much a simplification, but hopefully it's useful for those that perhaps are less familiar with the global minimum tax. Now I'd like to hand it over to my colleagues, Zach Buger and Steve Shea, who will take us through some of the recent technical updates for the globe rules that we think are especially important for developing countries to understand. Over to you, Zach.
I haven't seen Zach yet. My name is Steve Shea, and I think I'll pitch in for him.
Thanks, Steve.
Um, uh, and Enye, did you want to make a few remarks before I begin? This section of the presentation is by volunteers from the International Senior Lawyers Project, and let me just ask Enye if she can provide some background.
Thank you very much, Steve, and apologies for joining in late. I had a bit of a technical glitch on this end, but Ali, thank you for the opening remarks and for laying the foundation for this webinar. Really delighted to be here. My name is Enye Obebo. I work for the International Senior Lawyers Project, also known as ISLP, and it's always a pleasure to continue our work with the IISD. Ali has mentioned, I believe, the guide that we published and really the basis for this webinar. Again, following the publication, we've continued to engage quite actively with various revenue authorities and our government clients, including various, what do you call it, communities, what do you call it? Sorry, trade economic communities, where we've done high-level presentations of the guide, as well as now doing a legal impact assessment for one of our government clients on the impact of the global minimum tax on their investment incentives and tax system. So really, it's an ongoing thing, it's an ongoing effort, and the purpose of this webinar, as Ali has already sort of said, is really for us to take stock of all these developments and review the rules, updates to the rules, and also hear from our stellar lineup of speakers, which Ali has, I believe, introduced. Who help us unpack the topic, and also hear from them their thoughts around the proposed UN Convention on Tax on the ongoing tax reforms. Steve and Zach, thank you very much. They are volunteers and have also been the co-authors of the guide. We're really delighted again to be part of this ongoing efforts around building awareness around the global minimum tax and the developments. So that's it from my side. I would just also mention that please, we want this event to be as interactive and as engaging as possible. Please type in any comments or questions you have in the chat box, and we'll do our utmost best to respond momentarily or shortly hereafter. Steve, over to you.
Thank you, Enye. And so this is labeled technical update because what we're going to cover here, again, also at a very high level, are some of the developments that have been elaborated on since our guide was published. And we're going to start with the design of a QDMTT. And again, for those of you who are expert in Pillar 2, this is going to be quite familiar and indeed not very detailed for you, but for others, I think there are a couple of key points that we want to be sure that particularly developing countries are aware of. So in general terms, the qualified domestic minimum top-up tax, which I will refer to as the slide does, QDMTT, is incorporated in a country's legislation. That's important. In other words, the country has to take action in order to claim the right to tax, and it does so by adopting a qualified domestic minimum top-up tax. That legislation, under the rules and commentary, must align with the general definitions in the GLOBE rules, the global minimum tax. When I refer to GLOBE, that's the global minimum tax, and the rules determining the location of an entity that's going to be subject to the tax. So the key point about that is the rules applying to the QDMTT get into issues such as what entities are covered by the minimum tax. What are some of the definitions? And very importantly, what are some of the filing obligations? The local legislation needs to be designed with some degree of closeness or alignment with those rules, and in order to be considered a qualified domestic minimum tax. Now, if you're going to say, well, Steve, what tells me it's qualified? Well, you have to, and your colleagues or advisors need to read the rules and try and design it consistently with the rules. But ultimately, the GLOBE provides for a peer review process. that will make the conclusion as to whether a QDMTT in a particular case is GLOBE compliant. So in a sense, we won't know until we start seeing the outcomes of those processes, whether some material variations or efforts to stretch the rules will cause the top-up tax, the local qualified domestic minimum top-up tax, to fall out of being a qualified tax. And I think that's a very important point. So at this stage, there really does need to be, if you want to play it safe, you need to try and follow the rules as best you can, given your local circumstances, if you're a developing country. Mention here the filing obligations. You need to collect information that's consistent with what would be collected under the GLOBE information return, and there be good information about that. And you may want to be working with taxpayers to make sure they get the right information. And in terms of the liability of the QDMTT, when there are multiple entities in your jurisdiction, there will be allocation rules for allocating the liability between them. Now, the jurisdictions are free to choose the allocation approach applicable to their in-scope entities, and other jurisdictions are not required to follow the local approach. So there are going to be some disparities here. But the most important takeaway message is try and stay as close to the rules if you want, as you can, if you want to be sure that it's going to satisfy or be treated as the qualified domestic minimum top-up tax. And that is important because that is what puts the jurisdiction's right to tax, the local jurisdiction or the source country, as Ali referred to it, ahead of the ultimate parent jurisdiction, and ahead, if there is no ultimate parent jurisdiction that is in a participating country, ahead of the application of the undertax profits rule jurisdictions. So this qualification is a big deal. Next slide, please. And any, Ali or anybody want to add to that? Any comments? Okay, we'll keep going. So the second set of issues we wanted to just touch on are, there have been a number of safe harbors adopted since the initial rules, and they fall into two buckets in my view: the transitional safe harbors and the permanent safe harbors. And as we'll see shortly, the one that is most important for developing countries is the qualified domestic minimum top-up tax safe harbor, the permanent QDMTT safe harbor. But even there, how important it is going to be contextual. So we'll come back to that. But first, can we go to the next slide? So the transitional safe harbors. CBCR stands for country by country reporting rule. So the CBCR safe harbor is really for the benefit of the multinationals, and in my judgment, and it's intended to allow these global firms that don't pose much of a risk to use their existing country by country reporting calculations, which have been in place now for a couple of years, in a tested jurisdiction, to show that they would be outside the scope of the rules, either under a de minimis rule or one of the other, or they have a high enough effective tax rate. So this is a very limited time that it's available, and it essentially is designed to allow the multinationals to get their global accounting systems in sync with the particularities of the GLOBE rules. My own judgment is it's not clear how helpful or even how important this safe harbor is for participating developing countries that do not themselves have country by country reporting, as they will have to supply some of their own analysis. let me turn to the second transitional safe harbor. This essentially provides an out for low-risk multinational groups to avoid application of the undertax profit rule tax for another year, for 2025. Once again, this seems to be designed in a way that is unlikely to affect developing country decisions regarding whether or when to adopt an undertax profit rule. Zach, welcome. I'm delighted to see. So I'll be turning us back to you in a few minutes. So let's go to the next safe harbor. The next slide, please. So this is the permanent safe harbor that I referred to earlier regarding the QDMTT safe harbor. And what does it do? What it does, let me first explain. Let's start on the left-hand side of this slide. The actual way we determine the top-up tax is after we take the top-up tax percentage and multiply it by the excess profit over the that it's subject to, which is over the SBIE or the substance-based income exclusion, we then subtract the QDMTT. That, as we've described, is designed under the local legislation of the country, and there are circumstances where it is not going to come up with exactly the same top-up tax number as the GLOBE rules. In that case, under the general rules, before you get to the safe harbor, there will be some additional top-up tax if it's less than the amount that you get under the top-up tax rules, under the GLOBE rules, excuse me. So it's to a company and to a country, in order to be sure that there's no additional top-up tax after application of the local qualified domestic minimum top-up tax, you have to satisfy the safe harbor. So let's go to the next slide, please. Okay. The safe harbor involves 3 additional standards. And they're actually not that different from what you would have applied under the general rules for QDMTT. So this is by assuring satisfaction of these 3 standards, then you can be sure that if your country adopts a QDMTT, there will be no additional top-up tax as a result with respect to low tax, what would otherwise have been low taxed income in the country applying the QDMTT. The accounting standard essentially says the financial accounting rules that are relied on in the local QDMTT have to either be those of the ultimate parent country's financial statements or a local financial accounting standard rule that meets some fairly minimum standards. I think that should be, I would not expect that to be a difficult standard to satisfy. The second, the consistency standard merely says that if there are local legislation departures from the GLOBE rules, they're very narrowly allowed. They have to be within the rules that are permitted under the commentary, within the exceptions that are permitted under the QDMTT commentary, or one of the options. So this is probably the consistency standard is one that in designing the QDMTT, if you want to fit the safe harbor, you need to pay attention to. And then the administration standard is pretty straightforward, requiring ongoing monitoring process, including making sure that the information that's collected is consistent with the approach that we'd be taking under the GLOBE information return. So can we go to the next slide, please? So my observations on the permanent safe harbors for a developing country are the real benefit of it depends on the extent to which the QDMTT would otherwise result in a top-up tax. In other words, if the rules that are adopted in the local legislation are not aligned closely with the GLOBE rules, such that there would be potential additional top-up tax that would then have to be paid under the general rules, then the safe harbor is useful. And that's a question that you'll have to examine after the legislation has been at least proposed or set out. And then there are some permanent simplified calculation safe harbors that I have not reviewed here, and largely it's because they have substantially been left for future work. So we're not going to spend time on those in this presentation. Next slide, please. Okay, I think I'm going to pass it over to Zach now, who will take on the third issue we're talking about, which are, so we've covered QDMTT, Zach, we've covered the safe harbors, and now we're moving to tax credits. Zach, over to you.
Thank you, Steve, and good morning, everyone. Thank you for covering the QDMTT, Steve. I guess maybe one quick comment I'll make there is the point out the flexibility that has been given somehow in the guidance lately to countries in designing their QDMTT. So we used to think that you will have to basically copy and paste the rules from the GLOBE rules for your QDMTT design, but there is a little bit more, it may be a lot more flexibility that countries have been given in designing their QDMTT, as long as you are looking after the outcomes that are similar or identical to GLOBE. So maybe that's just one thing I will emphasize before I move into tax credits. And I mean, this is an area that is getting a lot of traction in the private sector, in jurisdiction that the US is more relevant than in some developing countries, but it is a topic that we cannot not touch on when we talk about GLOBE, right? And maybe the main focus of this discussion would really be trying to drive home the distinction between our qualified refundable tax credit and other tax credits that may not be qualified per GLOBE rules and per the OECD. And here we give you a little bit of a table that summarizes where your credit might fall within. So if you have a refundable tax credit that is refundable within 4 years, you usually will have it as a qualified refundable tax credit. And we'll talk in a minute what that means to be qualified or not qualified, but really just as in laying the background is understanding that you'll have your qualified and your non-qualified, and usually a lot of private companies will want to be within the qualified refundable tax credit, which usually will include your fully refundable within 4 years tax credit and your transferable and marketable tax credits. And as you design your policies for the government officials that may be on this call, you might want to keep in mind that you will be more attractive if you're able to offer qualified refundable tax credit, meaning usually fully refundable credit within a period of 4 years. And if we go to the next slide to double click a little bit on actually what it means and what companies might be looking more into refundable tax credits, because the conditions, we outlined them already, right? Refundable, paid in cash or cash equivalent within 4 years. Those will be your two main requirements. And then we talk about the transferability and the marketability. And the consequence for Pillar 2 purposes is if you have a qualified refundable tax credit, the amount of the credit will be treated as GLOBE income. So it will be treated as an amount to be added to your denominator in the computation of your GLOBE effective tax rate. So if you have $100 of credit and that qualifies a refundable within 4 years or a transferable and marketable, you are looking at that amount to influence it, to affect your denominator. And the reason why you would usually not want, and when I say you, I'm referring to multinational companies here, they will usually not want to have a non-qualified refundable tax credit, is because if it is non-qualified, usually it will be $1 per dollar reduction to your covered tax. So it hits your numerator really hard, and that is usually not helpful for purposes of computing your effective tax rate. So from a government perspective, as you design, keep in mind that a lot of your taxpayers will be looking after and appreciating more your refundable, qualified refundable tax credit. So if you can offer fully refundable within 4 years, that's probably be the most attractive. And then from a private sector perspective, you usually don't want to fall within the non-qualified category because you don't want a direct hit to your numerator and your covered taxes, because you don't want that to reduce dollar per dollar. Usually your covered taxes, the numerator of your ETR computation. And then if we go to the next slide, from a developing country perspective specifically, we know developing countries are not necessarily, again, this is not a topic that is completely widely used within developing countries, right? But as some of this applies to some of the governments, you just gotta keep in mind that impact that the tax credit we have on globe, the impact is more if it is non-qualified, and relatively not as impactful if it is qualified. So you may limit the ability to provide tax credits in general, just because of the effect that they have on the globe. And a lot of developing countries, they have included some of these provisions as part of their some number of political compromises, right? So you might want to, if you review the incentives that you provide or the tax credit that you provide, you might want to keep in mind the origin of this, maybe because of some political compromise. But really the goal of this section here for tax credit was basically to discuss the difference between the qualified and the non-qualified and how they affect your ETR computation. Namely, your non-qualified will be a direct hit and a decrease to your numerator on your ETR computation, while your qualified will be an increase to your denominator. And then we can probably take this further, maybe in the Q&A later, because some of the big companies are interested in the purchase of tax credits, right? So if you're not the one generating the tax credit, if you're not the one who earned the tax credit for the government, you could, in some jurisdiction, actually purchase tax credit that have been offered to somebody else. And the position of a purchaser with tax credit for Pillar 2 purposes is another interesting debate, because usually you purchase them from a discount, and the discount amount, if it is a non-qualified, will be a reduction to your numerator, your covered tax, and if it is a qualified, the discount will go into your denominator. So I know it was a quick run, and I only have a few minutes, but I'm looking forward to Q&A.
Thank you very much, Zach. Thanks, Steve. It's a complex topic, and so we appreciate you trying to bring some of the key updates to the group and illustrating why they might be important for developing countries. So we have a few questions that we're going to take now, and I'd really appreciate it, Steve and Zach, if you can be brief, because I think everyone is also eager to hear from our developing country representatives on their experience to date. So Steve, I'm going to turn to you first. The first question is really, there's been some debate in the chat around whether or not the global minimum tax addresses the fundamental issue of the allocation of taxing rights between source and residence countries, plus the question of whether or not it deals with the issue of profit shifting, right? Well, if multinationals were shifting profits out of the country anyway, then they were never going to be subject to tax, regardless of whether you implement a qualified domestic minimum tax or any of the other globe rules. So that's the first question I'm going to put to you. What are your thoughts and reflections on that? And the second one that I want to put to you is from our colleague Hans on the priority of the rules. So if you have a QDMTT in law, does it trump the income inclusion rule and the under-taxed profits rule? Thanks, Steve.
So let me take those in reverse order. If you adopt a qualified domestic minimum top-up tax and it satisfies the rules we've talked about, it takes priority. That's clear. So it puts the emphasis on over the IIR and over the UTPR. And if you satisfy the safe harbor, even if there's some leakage, nobody else will be able to tax that leakage. That's a simple way of thinking of it. With respect to Pillar 2, Pillar 2 does not address the allocation of taxing rights It does not change them from where they are under the law today. There is a provision in Pillar 2 that authorizes, indeed directs the local country to adjust the local financial statement results to arm's length standard in advance of as a kind of a first step. That has been very little discussed. It confronts countries with all of the same problems of applying the arm's length standards that exist. So in general, subject to that, it doesn't change the problem of income shifting, but it certainly has a clear basis for which a country adopting a QDMTT should say, first, you have to make the results in our country arm's length results, then you apply the QDMTT. Thank you.
Thanks very much, Steve. Zach, can I ask you, how is Pillar 2 enforced?
It's pushed by the OECD, and we all know the OECD. The OECD is not an enforcement body that really don't have. So Pillar 2 will be enforced at the jurisdiction level. So really, Pillar 2 has a number of mechanisms that will need to be the income inclusion rule, the UTPR, and local countries adopting QDMTT. So the application of Pillar 2 will have to rest with the local country, right? Whether it's the local country of the parent jurisdiction that is applying the income inclusion rule, or a third country that is applying the UTPR, or your own country that is kind of applying its own QDMTT, but the actual application and enforcement, if I could say it that way, will have to rest with the local jurisdiction.
Thanks very much, Zach. I'm just trying to see some of the questions that have come in Spanish and French. So I think one of the questions is, how is the tax base established on which the tax will be applied, and is the rate equivalent from one tax administration to another? So Zach, do you want to take that?
That was a long list. How's the tax base established? I guess that's the $1 million question, right? Because the OECD has tried really, really hard, and the blueprint goes into great details to tell us what the tax base is for you for computing actually your ETR. So you go from your financial statements account. So you go from your parent entity financial statement, financial accounting income, and then from there you make a number of adjustments which actually reflects the result of a number of negotiations that happened at the OECD during the Pillar 2 purposes. So the computation goes from your accounting income, and then you make your different adjustment to get to your quote unquote globe income. And that will be your base. And then you go in and apply your cover taxes to get your ETR for Pillar 2 purposes. So that's oversimplified, but that's a general idea.
Thanks very much, Zach. We've got a few other questions in the Q&A function. I will try and address them in writing as we go. But I just wanted to add my 2 cents. We will come to the question of the UN Tax Convention. As Sol has mentioned, we have Andrea from Colombia, and Colombia has been very active in the UN forum. And we think it's very important to acknowledge this development and understand what impact it might have on ongoing global tax reforms. But I also wanted to add that in our view as ISD, we appreciate that the global minimum tax is not a silver bullet. It doesn't change the allocation of taxing rights. It doesn't address the problem of profit shifting, although it will address some of the profit shifting issues arising from tax competition. But we think nevertheless that it's an important opportunity for countries to revisit their tax incentives. And we've seen firsthand, working with several developing countries, as Enya mentioned, undertaking economic and legal impact assessments, that there is revenue to be gained. And it's important that countries do this analysis first up to make sure that there is money on the table before they spend limited administrative resources on pursuing these reforms. We think that that's critical, and we put that up front in our guide. But nevertheless, provided that there is some money to be got, we think it's a worthwhile step and one that can prompt broader reform of tax incentives regimes. Zach. very quickly, and then I turn to
Yeah,
our
so
panelists.
I have to say something about this because Abdul put a really good comment in there saying this is a gift to tax advisors. As somebody who is in full-time tax advising, I just had to say something very quickly that may be true, but I wanted to address it, look at it from a different place, right? And we have a lot of developing countries at the table here. One of the truth about Pillar 2 is that it potentially put a number of new revenue on the table. There's revenue that gets put on the table. So if you're in developing countries and you're thinking about this as a gift to advisors, then you're missing the point. I think the point should be there's probably revenues on the table and find a way to make sure that your tax base and your revenues from your jurisdiction is protected, that you are the one taxing it. So I'm not going to say anything. Thank you.
Thanks very much, Zach, and thanks, Steve, for your contributions. There's a very healthy debate going on in the chat, so it's really good to have different perspectives and opinions represented here today. And we'll do our best to respond to some of the other questions in writing. Steve, Zach, if I could ask you to get on it. Now I'd like to turn over to the second part of our webinar, which is going to be very interesting, hearing from countries who are actually grappling with GLOBE, right, and deciding whether or not it's useful development for them, and if so, how to respond. And we're joined by several colleagues, representatives of developing countries and academia as well. Firstly, we're joined by Sam Lowe, and Sam Loy. Sam is the Commissioner of Taxation for the Internal Revenue Commission, the Tax Authority of Papua New Guinea. Welcome, Sam. It's great to have you with us. We're also joined by Matthias Chinanai, who's Head of Technical Services for the Zimbabwe Revenue Authority, ZIMRA. Andrea Preto, who's an advisor on international tax for the Directorate of National Taxes and Customs in Colombia. And last but not least, Vikram Chand, who's Professor of Tax Law and Policy at the University of Lucerne. So welcome to our panelists. Thank you very much for generously sharing your insights and experiences. Sam, I'm going to turn to you first, if you're with us. Sam is also joining us at a very uncivilized hour in Papua New Guinea. I think it's well past midnight there. So thanks, Sam, for being with us and awake. So Sam,
to be on the chat.
Thanks for being here. Sam, Papua New Guinea is in the process of deciding how to respond to the global minimum tax. What considerations will influence PNG's response? And what practical steps has the IRC taken towards making this decision so far? And finally, what challenges do you envisage along the way? Thanks, Sam.
Thank you, Ali. And firstly, let me thank IISD and ISLP for the opportunity for Papua New Guinea to share. And I think, like any country that is, especially from a tax administration point of view, the first thing that we, in deciding how to respond, was looking at, several factors. One of that key one was the impact assessment. And I think looking at the economic impact that was done by the OECD, which projected around, I think we all know the figure, around US 220 billion, well, roughly 9% of CIT, corporate income taxes. For PNG in particular, the preliminary estimate is suggesting something like USD 140, which is about, like in terms of PNG's revenue take, that would be quite a significant amount. 1/3 of that, about 42 million USD, is about 6% of CIT revenue. So I think from a revenue impact point of view, that is already a significant consideration. And I think this is also, given the time that countries have, which is not much, and I believe there's a number of several countries have already publicly announced, and amongst those countries, we have a couple of important trading partners with PNG that most likely going to be implementing. So if we are not going to implement quickly, then we stand to lose the wanted, especially under the qualified domestic minimum top-up. So I think that is one of the compelling reasons. The other things that we see considerations are the legal implications, particularly around the tax incentives, because PNG is a low tax jurisdiction. We have quite a number of tax incentives in our regime. Also, we have some contracts with investors, and the GMT may reduce the effectiveness of certain tax incentives, potentially leading to revenue losses for PNG. So I think one of the things that we are considering is evaluating some of these legal risks associated with implementing the GMT and considering how to address the conflicts, if any, exist with those investment agreements. We have some of our agreements also protected through a fiscal stabilization agreement. So I think that is one of the challenges. And we also have, in addition to that, there is other, investment incentives like the special economic zones that also poses a big risk for us. And in order for, like, one of the consideration is the policy objectives that we have to look at. We need to align. One of the consideration is trying to align the response to GMT with the broader policy objectives, especially ensuring that it fits into the country's investment strategy and economic development goals, as well as the overall tax policy. So these are some of the things that we are considering. I think the challenges, or especially the practical steps that we have taken, what we have done is we've requested some expert advice, and I think thanks to the OECD and our IISD for helping us in this space. They've done some work in terms of preparing some briefing notes and initial reviews for us in terms of the impact of the GMT in PNG. And we've taken some proactive steps by speaking with our policy team, and we've already had initial conversations in terms of the impact of GMT and adopting the global rules under especially the QDMTT. So I think that's one of the steps that we have taken. In addition to that, we also considering the potential conflicts that may, or disputes that may arise in some of these investment agreements. It's also an opportunity for PNG to also revisit some of these bilateral agreements, bilateral investment treaties, and then we can, because I think for us it's in any case, if we are not going to adopt the global rules, then it's going to get taxed anyway in one of those countries. So I think for us is to move in quickly. And like I gave the initial indication of the estimate, it's going to be 1/3 of the revenue that we potentially will lose if we don't adopt quickly. So I think that's basically some of the things. I think the challenges for us we envisage is the legal complexity. We cannot underestimate that, especially where we are. You have the political agenda of trying to increase investments, bring in more investment. Trying to give all kinds of incentives. On the other hand, you have to protect the base, the tax base and the revenue basis. So I think that's where the issue of some legal complexities and also especially policy alignment. And I mentioned the risk in disputes. The changes in the tax policy and especially in implementation of the GMT we have seen that could lead to some potential disputes with investors and multinationals, although we see that that could be low in terms of risk, but it will still raise some of those. So for us, addressing these challenges will require a comprehensive and a bit more strategic approach from PNG to be able to navigate all these complexities. And we are getting close to taking a decision. And in terms of the number of these MNEs that are in PNG especially, we have from our own data, we have identified there's over 103 MNEs that operate across, that come from 28 different jurisdictions. Out of that, at least 26 of them are already reporting under the CBCR. So I think that once we do the in-scope for the 103, then that will increase the number from 26 a bit upwards. So I think that's where we are at in terms of PNG considering the GMT. And I think the revenue impact is weighing a bit more heavier than the other aspects, but we take everything in consideration. So that's the PNG experience, and happy to take any questions.
Thanks very much, Sam. Appreciate you sharing those insights, and it's helpful. I think several people have said in the chat, questioning how much revenue there is to be gained by countries from adopting a QDMTT, and I think the experience in Papua New Guinea shows that there are actually quite a number of in-scope MNEs. There are certainly more than we expected, and that there is some money on the table, and so it's worth looking at carefully to see whether and how to respond. So I'd like now to turn to our colleague Matthias from the Zimbabwe Revenue Authority. Matthias, thank you very much for being with us. If I can invite you to unmute yourself. Matthias, I'd like to ask you, Zimbabwe is not a member of the OECD Inclusive Framework, but regardless, you have decided to implement the QDMTT. So what was the policy rationale behind this decision, and what challenges or opportunities has the Revenue Authority experienced to date in implementing this rule? Over to you, Matthias, if you can unmute and turn your video on if your bandwidth permits.
Thank you, Alexandra. Thank you for that question. Morning, afternoon, colleagues. And also thank you for inviting us to share our experiences from Zimbabwe with regard to QMDT. Yes, it's very true that Zimbabwe is not a member of OECD, but Zimbabwe is a player in the global economy, as you are aware. So we have an indirect relationship with OECD and other international organizations over the years, and we monitor the developments around the globalization, digitalization, and the solutions that are being put in place in different arenas in order to influence the domestic tax policies that are implemented in Zimbabwe. So we were also, like all other countries, watching cautiously, participating in various workshops and programs that were being held before 2024, including some done by IISD, some done through ATAF and the other organizations. So we had information around the Pillar 2, which is the solution meant to address the issues around the tax evasion, base erosion, and profit shifting. So we were informed, and because of that information that we had and explanations on how developing countries could respond to the developments under Pillar 2, we therefore developed a policy framework with that information. I think critical in this information was the issue that as developing countries were providing a number of incentives which were resulting in the MNEs paying less tax And therefore, when the Pillar 2 was put in place, it allowed us through the administrative guidance which was provided, it allowed us as developing countries to utilize the first right to tax the profits that are generated in our country. And so based on that understanding, we were in a position now to discuss with government in order to come up with the policy proposal to the whole of government, because the laws have to be passed through the parliament. So a proposal was made by the Minister of Finance in 2023 that there is a possibility of us raising revenue, which is a revenue mobilization strategy, if we are to put in place a tax which would be charged on subsidiaries of multinational enterprises that are operating in our country, such that if they are paying taxes less than an effective rate of tax of 15%, then we'll be in a position to claw back the effect of the incentives that would have given out to these taxpayers. So it is through the interventions from other parties and our understanding of the mechanics of the Pillar 2 that we were in a position to develop this policy framework and then put in place legislation. So the legislation was put in place in 2024, end of December 2023, but with effect from 1 January 2024, whereby we are subjecting to tax the local MNEs that are foreign owned if their effective tax rate is less than 15%. However, the legislation also refers to taxation of MNEs operating outside the country if they earn any income within Zimbabwe. However, we have received assistance with regard to the legislation that we had put in place. It has been reviewed with assistance from ATAF, and there are areas that we need to improve with regard to our legislation to take cognizance of the globe rules. As my colleague has been indicating in the presentation, that we need also to ensure that we comply with the globe rules to the extent it is possible within the confines of our own laws. So we are analyzing our legislation with a view to improving any areas that may result in inconsistencies. And also there are other areas that are not provided for in the current legislation, like the issues around filing, etc. So the legislation provides that the minister can develop regulations which can be used for the purposes of ensuring that all the operational issues and technical issues are brought into context. So those areas are being worked on right now, but we generally have the framework of the QMDT at the moment. In terms of opportunities, yes, we apparently expected to have generated revenue by now. I think the information that we had received was to the effect that once you put in place this law, then you realize revenue. But as Zek has indicated, there's work to be done in order to realize that revenue. So there is further work that we are doing in order to generate this revenue, which may mean that possibly well after 2024, that's when we can be in a position to generate the revenue. It's things that we have realized as we have, after we have put in place the law. And also you may take note that we've generally observed the globe rules are complicated to us. The process of translating them to domestic legislation requires expertise, which we are trying to obtain, like I indicated, through ATAF, through the World Bank. They are prepared to assist us to translate the global rules to domestic legislation so that there would be minimal inconsistencies, if any at all. And also the issue of administrative arrangements, guidelines for staff, guidelines for taxpayers, and the forms and returns, all those issues need to be worked out in order to have a well-functional tax system. Our taxpayers are currently coming forward to request for information. The same thing with our officers. They want to understand how this tax will actually be calculated. So we need to develop guidelines around that. I think, like has already also been noted, we need to further analyze the in-scope MNEs for Zimbabwe. Yes, we have companies that are operating in Zimbabwe. We also still need to update our lists of those that are affected by the tax, so that we'll be in a position to clearly determine how much, if any of tax that we can be in a position to generate from those taxpayers. So the issue of the database is very, very important. It means that we may need to share experiences with other countries again, so that will be in a position to identify the possible gaps. At the moment, our legislation does not have a threshold, the EUR 750 million, and we have debates around the fact of whether we should have that threshold or we can operate without it, because we believe that when we apply that threshold, there are chances that we have less taxpayers at the end of the day than we have currently on the list. So it's an area which we have asked for further guidance to say, is the issue of the threshold a mandatory requirement, or it is not a mandatory requirement?
Thank you,
So,
Matthias. Sorry, I might ask you to wrap
yeah.
up if you don't mind. Thank you so much.
Okay, yeah, I was just wrapping up to say, I think the other concern are the issues of reactions of the investors in the country, which would allow or require us to accommodate them and align our legislation. I would think in a nutshell, that is it. Thank you.
Thank you very much, Matthias, for sharing those experiences with us. It's really interesting to hear where you've got to in Zimbabwe, particularly being not a member of the inclusive framework, as you said. So I'd like now to turn to Vikram, Professor Chand from Lucerne. Vikram, we would be really pleased if you could share some of the work that you're doing with countries looking at how they're responding to the global minimum tax, in particular proposing the introduction of subsidy schemes. So many have said, while the global minimum tax tries to reduce the use of tax incentives, that now countries are looking at how they can use subsidies as a way of attracting investment. So what are your thoughts on this approach, and what should developing countries keep in mind when contemplating this?
Well, thank you for the question, Alexandra. So indeed, I've been helping a few countries, not only developing countries, but also investment hubs with the global minimum tax rules. And like a colleague from Zimbabwe already mentioned, there are a few challenges which, not only developing countries have, but also investment hubs and some other developed countries have. And one of the biggest challenges is just understanding these rules. Because the tax administration needs to understand these rules, and they are having a lot of difficulties in understanding these rules, number one. Second is transposing the rules in the national law. That was the second thing. And the number three was in relation to tax incentives, rethinking and redesigning the tax incentives. One of our previous speakers, they already touched upon the topic of qualified refundable tax credits, and qualified refundable tax credits can also be seen as government grants. So can subsidies. So, a lot of countries are just thinking about, well, what should we do? How do we react to the global minimum tax to ensure that we are competitive in the post-Pillar 2 world? Well, there are not many options which are available to countries. Two options amongst a few other ones too, of which we can speak about at another time. Two options is basically you either go through the qualified refundable tax credits route or you go through the subsidies route. So basically, countries right now are thinking, which route do we go down? What do we implement? Now, just to give you some examples, I mean, this information is there in the public domain. In Switzerland, which is an investment hub, not a developing country, you have one canton, which is Graubünden, and they have basically introduced a qualified refundable tax credit, and the credit is linked for activities in the area of innovation and sustainability, R&D, so on and so forth. Whereas on the other hand, you have another canton, which a lot of people probably know, which is famous, is Zug. Zug has gone down the subsidies route. Why has Zug gone down the subsidies route? And probably one of the reasons is because implementing and administering a QRTC, qualified refundable tax credit mechanism, can be quite complex from a tax administration standpoint. Because just to think about it, if you have a QRTC regime linked to research and development activities, you need somebody in the government who basically needs to understand what is the kind of research and development activity that the government is actually, that the taxpayer is actually doing. So if you have a pharmaceutical company coming and claiming for a QRTC scheme, you need somebody in the government to understand, well, the pharmaceutical company is actually doing this kind of research for them to grant the credit. So to cut a long story short, there is complex, from a government standpoint, it is quite complex to introduce a QRTC scheme, especially for governments who have no idea on tax credits. And that's the case for developing countries as well as investment hubs where tax credits are not commonly found. Coming to the subsidy side, this being said, because QRTCs can be complicated to implement, a lot of governments are thinking of going down the subsidies route. And there you have Zug in Switzerland, which has already made a public announcement. And then you have Vietnam in Asia, who has also decided to launch an innovation grant scheme for all the revenues that will be collected from the global minimum tax. So all the revenues that will be collected from a QDMTT will be transferred to an innovation fund. And then large multinational taxpayers can come and make applications. And if they have some kind of qualified activities and qualified expenditure in Vietnam, then they can actually get a refund from the government or subsidy from the government subsidizing that particular activity. So what I'm seeing right now is a few governments, they're actually going down the QRTC route, whereas some other governments, they're just preferring to go down the subsidies route. The issue with subsidies is, like everybody knows, is that it entails cash payment from the government. A lot of developing countries do not have the cash to pay out to multinational taxpayers. Whereas some countries, one of the big, large developing country I'm working with right now, for them, they just want to comply with the international standards or the OECD rules. They don't expect to raise a lot of cash from the global minimum tax rules. And because they will not be collecting too much cash from the global minimum tax rules, they are not thinking about subsidies as such. They're not even thinking about QRTCs. They just want to comply with international standards. That's about it. Whereas another country which I'm working with, currently they're really thinking whether we should go down QRTCs, the QRTC route or the subsidy route. One of the issues with the subsidies route, which I just want to bring out to everybody, is in addition to basically entailing cash payments from the government, you also have to think about the international law ramifications around subsidies. For example, you have the WTO rules on subsidies that have to be taken into account. Within the EU, you have the EU state aid rules that have to be taken into account. And now the EU has also introduced some foreign subsidy regulation that also have to be taken into account. So going down the subsidies path may seem a bit more easier than the QRTC path, but at the same time, just keep in mind you have to comply with the host of international law obligations too, whether you're going down the subsidies route or the QRTC route, in addition to the Pillar 2 route. I'll just stop there, and then probably I can take some questions during the Q&A round.
Thanks very much, Vikram. Really appreciate you sharing those thoughts with us. I'd like to turn to our final panelist today, Andrea from Colombia. And I think, Andrea, your contributions are wildly anticipated because of the special role that Colombia has on the Bureau for the ad hoc committee for the UN Convention on Tax, and also in relation to the tax forum in Latin America and the actions that you've taken as a country in relation to the global minimum tax. So welcome. Thank you for being patient. So the question is, as I said, Colombia is playing a leading role in the development of the forthcoming UN Convention on International Tax Cooperation. What would you say is the relationship between this development at the UN and the ongoing work on the global minimum tax? And also, if you have time, what is Colombia's position on the global minimum tax? Over to you.
Well, yeah. Okay. Thank you very much, Ali, for inviting us to be part of this wonderful event, which I have found extremely informative. I think that global minimum tax has captured everyone's attention since 2020, and it continues to do so. So yeah, we are delighted to be here sharing our perspectives on this popular topic and hot topic, as I can see from the chat as well. So regarding the interaction between the UN Convention under discussion and the OECD's two-pillar solution, we think it is a fair question because both processes are happening simultaneously, and both aim or would aim to address issues related to the taxation of multinational enterprises. However, the connection or relationship is not entirely clear, and this could be, in our view, and based on our active participation both at the OECD and the UN, due to three main reasons. First, the UN Convention and the terms of reference, the draft terms of reference that will define the rules of this new framework are, let's say, still in the oven. And this means that, for example, the scope of the issues the convention will cover has not been decided. And it also means that there is uncertainty about how substantive negotiations will proceed in the short, medium, and long terms. And this is, I think, expected because discussions started recently, and the issues are highly complex. So while what is happening at the UN is unprecedented and the negotiation process is on the right track, it is a little bit premature to predict everything that will occur under the convention and how it will interact politically and legally with discussions within the OECD inclusive framework. Secondly, based on the latest information from the zero draft of the convention's terms of reference, it is possible to conclude that the taxation of digitalized and globalized economy will be a key agenda item. This topic has been expressly included as part of the areas to be addressed in early protocols. And I don't think this won't change during the upcoming meetings in the next month in New York. So yes, this overlaps with discussions on Pillar 1, particularly Amount A, which has to do with the allocation of taxing rights and nexus, or which, by the way, has not been agreed on yet. However, this could be not the case for Pillar 2. Let's say that there's no mention of global minimum taxation or tax competition in the draft terms of reference, and there are no particular precedents of similar discussions in previous meetings, at least according to our recollection. Perhaps the UN could think of, for example, tax incentives or tax competition as part of a broader agenda. But the point is that this issue, as presented by the OECD, doesn't appear to be the immediate priority in the UN context. And lastly, the third reason is that the global minimum tax is based on a robust agreement endorsed by all IF members. So despite varying countries' position on aspects like joining the GLOBE system because countries are not obliged to implement it, or criticisms of certain design elements, all agreed on a global minimum tax of 15% under a common approach. And due to this political consensus, GLOBE is nowadays a stable and standalone project that is a reality, not only for IF members, but only for non-IF members, as we just heard. And it is happening and being implemented by several countries. And I think it will continue its course independently or in parallel with the discussions at the UN. It is important to recognize that things, of course, can evolve differently, and both, I think, the UN and the OECD can lead projects as their members decide. Tax discussions are not monopolized, but this is the picture we have today and the one we wanted to share with you. With respect to Colombia's position on GMT, in our case, Colombia has been an early adopter in Latin America regarding its position on the global minimum tax during OECD negotiations and with respect to the implementation phase. So, for example, at the beginning, although we recognize the need for additional tools to ensure MNEs pay their fair share of taxes globally, we have always believed that the rule order based on a top-down approach tends to benefit headquarters jurisdictions and limit the capacity of capital importing countries like Colombia to collect significant top-up taxes. Another concern that we had was the impact of GLOBE on tax incentives, especially based on substance. And I think this is why all the support the IISD is providing is key for developing countries and for other countries. Then when the agreement was reached and with a clear understanding of the potential impact for Colombia, including revenue losses and the loss of taxing rights, the government decided to implement a domestic minimum top-up tax of 15% to protect the tax base and tax collection. However, this decision was made before the official version of the model rules was released. So now, due to the numerous administrative guidance published since 2023, we are in the process of digesting this new information, assessing the outcomes derived from the initial application of our minimum top-up tax that will occur this year, in order to react in the best possible way to new developments and to ensure coherence with our policy objectives and tax system. And finally, regarding the implementation of IIR and UTPR, since these are not minimum standards and Colombia does not have many MNEs in scope or UPEs, our approach is less urgent. And for these reasons, we are taking enough time to assess how best to proceed with these rules because this merits a serious cost-benefit analysis. And we also want to see and reflect on what will be the effects after the implementation of IIRs, UTPRs, and QDMTTs by European countries and other key partners for our country. With that.
Thank you very much, Andrea. Appreciate it. We have limited time remaining, but I would like to at least get to a couple of questions that have come up that haven't been responded to. But I'd like to come to you, Andrea, first. And so I think you mentioned in the Q&A that this is something that you could address. So I think, you know, there's this point around, while lots of countries have, in principle, agreed to the global minimum tax, but a lot less have actually started to implement it. And in particular, a lot of developing countries are maybe dragging their feet, waiting to see what will happen at the UN. And the question was, you know, what's happened between 2021 and 2024? Did developing countries misunderstand the proposal? Did they not understand that incentives would be impacted? Do you think the countries kind of agreed without understanding the consequences? What's your thoughts on perhaps the slow take-up of GLOBE?
This is a difficult question, but I think that as as Globe relies on domestic implementation, you are always able to change your legislation or your policy, tax policy views on certain aspects. So depending on what happened at the UN, countries are free to change their perspectives on minimum taxation and the way how they can address tax competition following the OECD proposal.
Thanks very much, Andrea, for taking the difficult question. Vikram, I'd like to come to you next. So there's been some questions in the Q&A. I'm sure you've been following on the issue of tax credits. So the question is that refundable tax credits, which have been used in developing countries, have been given different treatment under Globe. And is it possible that developing countries will be pressured to migrate their income-based tax incentives to refundable tax credits? And what new risks might that present?
Well, absolutely. So effectively, this entire Globe and Pillar 2 project, so when you talk about the Globe rules, is the income inclusion rule and the under tax profit rule. In addition to that, you have the QDMGT, plus, there's another rule which is relevant for developing countries, is the subject to tax rule, which we didn't really speak about that much, but that's fine. But the combination of all these rules, it makes it really obvious that income-based incentives are going to be dead for large multinational enterprises. So, any country offering tax holidays, any country offering reduced rate kind of incentives, or partial tax holidays, full tax holidays, all this is just going to vanish in the post-Pillar 2 world, in the sense that, at least for large multinational enterprises. So I'll just be a bit careful with what I'm saying. But yeah, effectively, the Pillar 2 project kills income-based incentives, and the only incentives which can be offered by countries in the post-Pillar 2 world are expenditure-based incentives. Now, within expenditure-based incentives too, not all expenditure-based incentives can be offered. I mean, they can still be offered, but they are deeply impacted by the Pillar 2 project. That's what I mean. So a lot of expenditure-based incentives, such as tax allowances, for example, they are deeply impacted by the Pillar 2 project. So what countries can offer post Pillar 2 can be broadly classified into three baskets. You have accelerated depreciation rules, for example, which create cash flow benefits. Countries can offer qualified refundable tax credits. They can offer marketable transferable tax credits, and they can go down the subsidy routes. Now, these instruments, accelerated depreciation, well, yes, you find a lot of developed as well as developing countries having accelerated depreciation provisions. But what you don't find a lot in developing countries is QRTCs, tax credits, marketable transferable tax credits, as well as giving a lot of subsidies out to multinational enterprises. So developed country, I mean, to be honest, the way the OECD rules have been written, of course, there's some kind of bias towards the OECD member countries, because OECD member countries actually are the ones who offer these tax credit mechanisms. And a lot of developing countries I'm working with, they don't even know what tax credits are. So I had to explain to them what tax credits were actually and how they actually work. So let me put it like this: developed countries have, they are in a better position than developing countries at this stage. And unfortunately, developing countries who have traditionally offered a lot of income-based incentives will have to switch to these incentives in order to retain the competitiveness and attractiveness. Otherwise, they may just lose out to other developing countries who basically introduce these kind of incentives, post-Pillar 2 compliant incentives. And this is what I'm seeing in the Asian region too. And because, if one country, Asia is a manufacturing hub, just for everybody to know. And if one country in Asia introduces some tax incentives to attract manufacturing activities which are compliant with post-Pillar 2 rules, for example, subsidies or qualified refundable tax credits, and from an investor standpoint, the investor will go to that country as opposed to the other countries. So there's a possibility that the other countries who don't introduce these rules, they may also lose out. So unfortunately, developing countries have to rethink their tax incentives. And this is a painful point for developing countries, but they have to do it. I'll stop there.
Thanks very much, Vikram. And last but not least, Sam and Matthias, if you're still with us. So I wanted to, we've had this similar question coming up in the Q&A, which is really around why not consider a simpler approach to a qualified domestic minimum tax? So I think Andrea spoke about Colombia having earlier adopted a similar or simplified minimum tax and now transitioning, but whether or not that's a consideration for Papua New Guinea or Zimbabwe, do you feel that the qualified domestic minimum tax is going to be implementable in your jurisdictions? And is there an option to consider a simpler approach? Sam, do you want to speak to this first?
Yes, thank you. And you know, every new measure that comes out is always, for tax administrations, it's very complex, and we try to understand what the implications are. With the QDMTT, I think for PNGs, like adding the other two backstops is going to be quite a complex step for us. And looking at just basically the QDMTT would be the option that we're looking at. But the question also is how we'll putting the rules into legislation. That is going to be the biggest challenge for us. And I think that's why we look, interested in countries that have been able to look at other options, much as especially codifying the rules into the law. That's going to be the I think for us the policy sell is it's easy because we can make the business case on the revenue impact, but codifying the law is going to be where the challenge is. And I think it's interesting to see here what Vikram is saying, where the trends are now moving into subsidies and the credits, because I think for PNG we have legislation just been introduced on special economic zones, giving tax holidays and all of these things, and it's becoming quite it's a policy pull between investment versus trying to protect the base revenues. So I think for us, we're analyzing what is currently available, which is the Pillar 2 minimum tax. We also have, I think, on the Pillar 1 option, we are looking at other options in the GST space, which I believe is not part of the Pillar 1 scope. So I think those are the other options that we are looking at, apart from just the Pillar 2 itself. I hope that's helpful.
Thanks very much, Sam. And I think, there's been some comments in the chat about the different policy options for governments in responding to the global minimum tax. I encourage you to have a look at IISD and ISLP's guide in that regard. We do go through several options, one of which is do nothing for countries for whom this don't stand to benefit. But for those countries where potentially there is revenue to be gained, then looking at the options of a QDMTT, an alternative minimum tax, and of course a systematic overhaul of your tax incentives regime, which is our preferred option because we think it is the most sustainable and thorough, but we also recognise that it can be difficult to undertake politically. So the global minimum tax provides some new momentum and impetus for countries to make these changes, potentially through a QDMTT. Matthias, can I invite you to speak to, just very quickly, whether a simpler approach is an option for Zimbabwe, but this question of, you mentioned at the start of your remarks that incentives have been a problem in Zimbabwe for a long time. So if incentives were the problem, why not repeal them directly rather than going through the complexity of adopting the global minimum tax? Thanks.
Thank you, Alexandra. You see, tax incentives have a lot of other issues that are associated with them, such that if you are to take that route of removing or reducing the incentives, there will be too much pressure to the extent that you will not be in a position to mobilize revenue. So we find that the implementation of the QMDT is an indirect way of dealing with the tax incentives in a smarter way. So a simplified regime for us is the most appropriate thing, I would say. Thank you.
Thanks very much, Matthias. Can I ask you just to come back on that second question, which was, if tax incentives were a problem before, why didn't the government repeal those incentives? Why is it only now that you're looking at a qualified domestic minimum tax to address that issue?
Okay. What I said was, if you wanted to address tax incentives, you will find that it becomes an obvious issue to the investors and other players in the country. So a direct reduction of tax incentives may not find favor from a number of players, internal, external, and even international. So for that reason, we find the DMTT to be an indirect way of addressing the issue of incentives in a way which at the end may face minimal resistance than if you are to directly deal with the incentives. Yes,
Thanks very much. That's very helpful. Appreciate it. Thank you very much to our panelists for your really insightful remarks. In the last couple of minutes, I would just like to invite my colleague Kutsi to say very briefly, David, if we can get the slides back up, some very quick words on a new publication that we're putting out today, which examines the interaction between the global minimum tax and special economic zones. Kutsi, over to you.
Thank you, Ali. I hope my connection is clear enough. Thank you, David, for the slides. Next slide, please. So today it is my pleasure to launch a new IISD policy brief on the need for reform in SEZs. This publication comes after months of working with various developing countries, some of whom are represented today, where we have come to a greater understanding of the impact and also the current use of tax incentives within special economic zones. So some of the key highlights I would like to share with you is that currently we have noted 6,000 zones in 150 economies since 2022, which is information we've always known, but in the context of the global minimum tax, the linkage between this growing use of tax of special economic zones with also an increased use of tax incentives in these zones as a central policy has become rather alarming to us. We are currently aware of the fact that about 80% of SEZs, special economic zones, offer tax incentives, with tax holidays being amongst the most common sort of incentive used. Within the context of the global minimum tax coming into application, and also this growing knowledge that we have about the mixed or sometimes unclear linkage between tax incentives and investment decisions, we think that this is an opportune time for countries to be using the momentum built by the global minimum tax for tax incentive reform to be relooking at their use of tax incentives within special economic zones. We've been working with countries such as Papua New Guinea, for whom special economic zones are a key part of their industrial and development plans. And through this work with them and other countries, we are encouraging countries to relook at the utility of special economic zones and also the functions they seek to achieve through the use of special economic zones, noting that the global minimum tax will make many of these incentives redundant. It is our belief that reform is urgently needed to prevent a transfer of revenue. And on the next slide, I encourage you to download our new publication, in which you will have many questions answered. For example, the history of special economic zones, the prevalence of tax incentives, but also this growing interaction between the global minimum tax and special economic zones. And what we do in this publication is also give countries a step-by-step guide of considerations they should keep in mind when deciding whether or not a tax incentive is the right instrument to use within a special economic zone, and perhaps what the alternatives to reach the same objectives could be. I think in the shortest time possible. Ali, that is all I would like to say. And I encourage you once again to download our report, which was launched just yesterday.
Thanks, Kudzi. And we can leave that on the screen for a moment so people can get the QR code. Encourage you to dive in and have a look, and we will have a webinar dedicated to this topic in September. So last but not least, I'd like to firstly thank all our participants for joining us today. We appreciate you making time to be with us, and thanks for all the great interaction. Thank you to our interpreters. Thank you to our panelists, to Steve and Zach and Kudzi, Sam, Andrea, Vikram, Matthias. Thank you all for your contributions today. And in particular, thank you to Enye and the partnership with the International Senior Lawyers Project. To conclude, I wanted to share a few final thoughts. Feel free to log off. Just to summarize, I think our view at IISD is that tax incentives have shown to have limited effectiveness at attracting investment over the years. There's been many studies that have shown that there has been very little gained by offering tax incentives. It hasn't materialized in sustainable, high-quality investment that developing countries urgently need. Despite that, despite knowing that, for many decades, we've also struggled to undertake tax incentives reform. We've had very limited success at convincing policymakers in countries that they need to repeal harmful tax incentives. And to this day, we see countries continue to introduce very generous corporate income tax holidays and so on. And so there's a problem, right? We know that tax incentives have had limited effect at attracting investment. We know that they result in significant revenue foregone, but we seem to have great difficulty at removing them. And we think at IISD, and I think at ISLP as well, that the global minimum tax offers new momentum. It's an opportunity for countries to reconsider the design and use of incentives and other investment promotion tools. It provides important political cover, as I mentioned at the start of the webinar today, that makes reform possible for some countries in a way that perhaps previously it was not, because of the pressure put on countries from multinationals, because of the difficulty of even beginning to identify all of the incentives and deal with them one by one. We know that incentives are often very diffuse across countries' legal systems. So we think that the global minimum tax is an opportunity for countries. Of course, they need to evaluate that opportunity and consider whether it's appropriate for them. And our guide aims to set out some of those considerations. Of course, the economic and legal impact assessment to understand if it's worthwhile for countries to explore. And then what are the different ways that they can respond: a QDMTT, alternative minimum tax, overhauling the tax incentives regime more broadly. So we think that that's all very important work to do. Today, we've chosen to focus on the implementation experience of several countries. And I think so far, many countries that are responding to GLOBE are doing so by adopting a qualified domestic minimum top-up tax. Whether that's right or wrong, we don't necessarily have a view, although I do think that the more you deviate from these norms, the more you create additional complexity and the potential for disputes. So we feel that countries should consider their options. We've heard from several colleagues today what the experience has been so far, from Sam in terms of the money that they stand to collect by adopting these rules and why it's important for them, but also some of the challenges that they face with respect to their fiscal stabilisation agreements, BITs and so on. From Matthias as well, I think it's interesting to hear that tax incentives reform has long been on the agenda, but perhaps there hasn't been the political momentum or the will, or indeed the simplicity of providing, adopting a top-up tax that will make those incentives redundant. And also from Vikram on the rise of subsidies, and I think that's something that we need to watch. Of course, there's a risk here that developing countries become even more disadvantaged by taking tax incentives off the table and relying on subsidies. So that's a really important thing that we need to take into consideration, and developing countries should think about, and I'm sure they already are. And then we've also heard from Andrea around the interaction with the UN Convention on Tax. And we certainly think that there's a lot of work that needs to be done when it comes to reallocating taxing rights, when it comes to addressing the fundamental imbalances that exist in the international tax system. The global minimum tax was not intended to do that. It does not achieve that. And there is much work ahead of us to achieve that. But we think that it can be a useful tool for developing countries to make those much needed reforms to their investment incentives regime. So thank you for being with us today. We appreciate you staying with us a little longer than was anticipated, but I think that was largely thanks to all of the questions and interaction from the group. So thank you. We hope that you found this useful and insightful, and we certainly learned a lot from the exchange with all of you. Thank you, and I wish you a good rest of your day.